Types of LBOs. There are three major types of leveraged buyout transactions, and they include taking a public company to the private sector in the form of a reverse leveraged buyout transaction. Next is financing spin-offs. And then last is making private property transfers, frequently related to ownership changes in private small businesses. In a reverse leveraged buyout, there is a transaction where a public company is taken private. This type of transaction occurs when an investor and/or investor group of investors buys all the outstanding stock of a publicly traded company and thus turns the company into a privately held enterprise, which takes a public company private instead of going public. These specific deals can either be gregarious or hostile. It depends on the view of the management. In the most friendly cases, management will buy a target company for its own portfolio and thus plan to operate the company after it's privately held. In the aggressive cases, this process will involve an investor and/or a group of investors having intent to buy, reorganize, and then resell the target company again to generate a higher profit and return. This specific sale and/or exit of the company can be made to another company or in the form of a public stock offering. There can also be the other scenarios where there is a payback of a third-party investor, which could lead to very high dividend payments and recapitalization by other groups. Financing spin-offs in order to generate liquidity and accessible cash. Most public or private companies have an option to sell off parts of their business. In certain cases, the seller can be bought in a leveraged buyout, which will spin off assets back to investors involved in the deal. In these certain scenarios, the spin-off management team can become the buyer or can take a more passive approach in the transaction. The leveraged buyout deal is made to buy the subsidiary or division at hand. Small company private deals, which is the last occurrence, is when a privately held company is bought by a group of investors. These cases occur when a small business owner who is considered a baby boomer business owner and/or motivated seller wants to divest or sell his company and cannot find a large financial buyer. This buyer group could involve the company's employees associated with the owner of the company. This is organized in leveraged buyout fashion because they only have limited equity. Steps in the leveraged buyout deal process. The leveraged buyout process usually includes 10 steps, which includes deal sourcing, screening for acquisition targets, non-disclosure agreement stage, doing due diligence, indication of interest, letter of intent, negotiating stages, making an acquisition, management, and exit strategy.